Today, we're diving into a pressing question. Are we heading for a recession in 2025? With major economies slowing down, inflationary pressures, and geopolitical tensions, many analysts warn that the next downturn could be just around the corner. In this video, we'll examine the key economic indicators that suggest trouble ahead, analyze what experts are predicting, and explore what this means for businesses, investors, and everyday consumers. Stay tuned to the end because we'll also discuss steps you can take to prepare for economic uncertainty. Let's get started. Global economic growth projections for 2025, according to the latest forecasts from the International Monetary Fund, IMF, global economic growth is expected to stabilize at 3.3% in 2025 and 2026. While this suggests a steady outlook, there are underlying concerns. The World Bank has warned that growth is still below pre-pandemic levels, and many emerging markets are struggling with high debt, inflation, and slow wage growth. Furthermore, the global economy is facing significant headwinds from the ongoing war in Ukraine, China's economic slowdown, and rising tensions in the Middle East. Supply chain disruptions, high energy prices, and trade restrictions could further dampen growth. Adding to these concerns, global trade is slowing due to increasing protectionist policies. Countries are imposing new tariffs and sanctions, which disrupt supply chains and make goods more expensive. The slowdown in international trade is expected to affect export-driven economies like Germany, Japan, and South Korea. United States, a slowdown in sight. The US economy has shown resilience, but cracks are beginning to appear. 1. GDP growth. The US economy is projected to grow by 1.9% in 2025, down from 2.4% in 2024. 1. This decline reflects weaker consumer spending, slower job growth, and tighter credit conditions. 2. Federal Reserve policy. The Federal Open Market Committee, FOMC, has indicated that it plans to cut interest rates twice in 2025, lowering the target range to 3.75%–4% by 2026. 2. This suggests that policymakers are preparing for economic turbulence. The real estate market is also flashing warning signs, with mortgage rates still elevated and home sales declining. Consumer confidence has taken a hit, with many Americans cutting back on discretionary spending due to higher borrowing costs and persistent inflation. Additionally, U.S. manufacturing output has declined for 3 consecutive quarters, signaling reduced business investment and weakening industrial demand. The Institute for Supply Management's ISM manufacturing indexes remained below 50, indicating contraction in the sector. Recession probabilities and key economic indicators. Economists are increasingly concerned about a recession. J.P. Morgan Research recently raised the probability of a U.S. and global recession before the end of 2024 to 35%, up from 25%. For 2025, the probability remains 45%. Some of the most alarming recession indicators include: 1. Increased business insolvencies. The number of corporate bankruptcies has surged in sectors like retail, construction, and hospitality. A report from McGraw-Hill warns that this trend will continue into 2025 due to high interest rates and weak consumer demand. 2. Declining consumer confidence. The latest surveys show a sharp drop in consumer confidence, with people worried about inflation, layoffs, and the stock market. Retail sales have weakened, indicating that consumers are becoming more cautious. 3. Stock market volatility. Major indices like the Nasdaq and Russell 2000 have seen significant losses. Even tech giants like Nvidia and Tesla have experienced double-digit declines. Market uncertainty and corporate earnings downgrades could trigger further downturns. 4. Rising debt levels. Government debt, corporate debt, and household debt are all at record highs. The U.S. national debt has surpassed $35 trillion, and many businesses are struggling with expensive refinancing costs. 5. Unemployment concerns. The job market, which has been strong for years, is showing signs of weakness. Tech layoffs continue, and the gig economy is facing new regulations that could reduce opportunities for freelancers and contractors. Geopolitical risks and trade disruptions beyond domestic factors. Global economic risks are adding to the uncertainty. 1. China's economic slowdown. China's real estate crisis, high youth unemployment, and weak manufacturing sector are dragging down global trade. 2. US-China trade war. Tariffs on Chinese imports have increased, leading to higher consumer prices and supply chain disruptions. 3. Middle East tensions. Rising instability in the region could impact oil prices, leading to higher transportation and energy costs worldwide. The potential for an escalation in geopolitical conflicts remains high. If tensions in Asia, Eastern Europe, or the Middle East intensify, it could create an energy crisis, supply chain shortages, and even financial market disruptions. Europe and emerging markets, more trouble ahead. 1. United Kingdom. The UK economy is facing stagflation, with zero growth recorded in the third quarter of 2024. 1. The British pound has weakened, and business investment is slowing. 2. Emerging markets. Developing economies are struggling with currency devaluations, capital flight, and high inflation. 2. Argentina, Turkey, and South Africa are particularly vulnerable. 3. Eurozone slowdown. Germany, the largest economy in the EU, is seeing shrinking industrial output, while France and Italy are also experiencing economic stagnation. How to prepare for a possible recession given the rising risks? Here are some strategies to safeguard your finances. 1. Diversify your investments. Consider allocating assets to gold, bonds, and defensive stocks like utilities and healthcare. 2. Strengthen your emergency fund. Aim for at least 6 to 12 months' worth of living expenses in cash savings. 3. Reduce debt. Pay off high-interest debt to avoid financial stress if the economy worsens. 4. Invest in recession-resistant industries. Sectors like consumer staples, healthcare, and cybersecurity tend to perform better during downturns. 5. Stay informed. Keep track of economic trends, monetary policy, and global events to make smart financial decisions. Conclusion: the warning signs of a recession are undeniable. Slowing GDP, rising debt, weak consumer sentiment, and global instability. The key takeaway: be proactive. Whether you're an investor, business owner, or everyday worker, preparing now can make all the difference. What do you think? Are we heading toward a full-blown recession, or is this just another economic slowdown? Drop your thoughts in the comments below, and don't forget to like, share, and subscribe for more in-depth financial analysis. See you in the next video.